My name's Kris Krohn, and welcome back to the Kris Krohn Show. And today I am joined by Carson Tejan, my apprentice.
What's up, everybody?
And Carson, in this last episode, we were talking about equity, but I gave you a really big challenge. I basically said, I don't know if I want to continue my mentoring with you unless you can get me a more accurate size up of your portfolio. I need to know what equity is available because you know the game. In real estate, we're always rolling money out of these homes and into more homes because we want to go from 1 home to 2 homes to 4 homes to 8 homes to 20 homes to 100 homes. And that's how we build family legacy. But along the way, you got a little stopped up and it kind of upset me a little bit.
Well, you know, Chris, I've been running your game plan for a number of years, played a really conservative game financially for a long time, saving everything I could to be able to roll it forward and buy more real estate. And we saw some big wins over the past few years. And, you know, my wife and I aren't getting any younger, and we were excited to be into that home where we really felt comfortable. So we dove in and started looking at building a really sizable house, and it's underway. Talking with you about this whole game of equity, and I think there's actually a lot of ways that I can still cut back and make it a more conservative build than we were originally anticipating, and I think that made you happy that we're looking that direction. And I still believe that we'll be able to roll forward and continue to do real estate after the fact.
Here's the concern. Let's break it down all the way to the beginning.
Yep.
You bought your very first house. You put a 3% down payment. It was a small amount of money.
Yep.
How much money did you end up making on that house?
$180,000 about.
So I want to pause. Let's just say for a moment that you went to a really expensive film school and you're like, you know, we're going to use the $180,000 and we're going to wipe out all of our debt. Where would that put you after the few years you lived in that house that built that equity? Where would it put you?
I would liken it to like eating your seeds as a farmer. If you eat all your seeds, you have nothing to plant to continue growing the next season. And that would have been that. We would have just been eating our seeds and made us feel good in the moment and be like, oh, I have this weight off me. But that's it. Potential for growth is gone.
And I think that was my big concern was like, I saw you transfer that $180,000 into another primary residence and do a couple more doors. You know, in Florida, you bought well, your portfolio continues to grow. And when I saw this $1.3 million monster, I was like, wait, are you actually consuming your seeds so that you actually have nothing to replant with?
And honestly, as we've talked more about it, Chris, I think there are still a lot of options going into this new build. And outside of the house, everything else we're doing is very, very conservative. I've already saved up money. We're in talks on transferring a 401k to help push that forward and continue to build as well on the real estate portfolio side.
Here's a couple of things that I really want to jam on today.
Okay.
You put about $320,000 into the lot that you bought cash.
Yep.
And then the construction loan was based off of the equity in the lot. So you didn't need to bring new money to the table.
Correct.
So in my eyes, I'm like, okay, opportunity cost. That's $320,000 that I could have put into, let's call it 4 more homes.
Yep.
And I'm like, now my portfolio is like doubling and tripling again. But instead you put it into this, and I think my panic moment was, if you're gonna be my apprentice, I need to understand the willingness for sacrifice. And so I saw something that concerned me, but I saw something that I also liked. You see, in my mind, getting the numbers back, it's how much of that $320,000 can I recuperate? So I can still have the house. You got the basement above, right? The attic apartment above the garage that's going to help pay for over half of the mortgage. I'm like, okay, those are all smart moves, but what about my tied up $320,000? So here's what kind of shocked me in that episode that I was not anticipating. I want to talk about some of these line items. You and your wife met up and decided, all right, we're not going to do the pool. Let's start with that one. Was that a hard decision?
Before we talked, it would have been, but after we talked, it's a no-brainer.
Well, so look at this. You're about to move into this beautiful new home. Your kids are literally going to go from like 0 to hero. There's so much new. There's so much space. There's yard. There's all these opportunities. But if you advance too much to yourself too quick, again, that seed is being cast off. And by the way, I've never heard of a $60,000 pool. Like a $60,000 pool, it turns into a $200,000 pool overnight. That was a really, really smart one. And part of me is also like, have a little more success, put a pool in.
That's kind of where we were at with it. It's like, we can wait on some of this stuff.
Yeah.
Like, we can continue working, saving, rolling our portfolio forward and seeing the benefits from it. And then as that grows, we can add on.
Yeah. Ownership is always cool, but I remember the first time ownership slapped me in the face. My wife really wanted an RV. She's like, we want to be an RV family. And I'm like, I'm an international traveler. I like to get on planes. Later, I would own private jets. And she really wanted this RV. And so we went all out and bought this like $100,000, 45-foot, bumper. It wasn't a Class A. And I remember going through the learning curve. I hated the thing at first. Because first of all, dude, you should have a special license to know how to even drive these things. Within the first week, I got into 4-ish accidents.
Gosh.
I'm not joking. Like, first of all, I didn't stop in time because I didn't have my brakes hooked up, and I bumped the car in front of me. So accident number 1. And then we were trying to like learn how to pull this really long thing from my truck into this KOA. And we ended up like hitting this tree and it ripped off the awning. So I was like, oh, there's several $1,000s. Then I was trying to back it into my driveway from our circle. I got frustrated because I couldn't get the angle right because everything's counterintuitive. Turn the wheel this way, got to go that way. And so I ended up jackknifing my truck into the side of the thing. It was like another $3,000 replacement. In the first week, dude, I'm wrecking this thing. I'm so angry. But 5 years later, we had only used it like 4 times. And I was like, oh, cool. You know, that was only like $25,000 a trip. I could have rented something collectively for those 4 trips for a few grand and had the same experience. But no, I wanted to own it. So my wife and I started creating rules because we ended up selling it. And one of the rules is you should know your usage before you buy something. If you don't know, like for example, let me ask you, I assume you like to swim. Are you guys like, we like to swim in the summer every day? Are we like, no, we're casual swimmers. We swim once a week or maybe twice a week. Or no, I'm sure there'd be a couple of like family parties and picnics during the summer. We'd probably use it a few good times. Like
It's more like several times a week.
Yeah, and when it becomes several times a week, that's when it becomes anticipated. Then it's like, oh, ownership becomes really a good choice there because it's like, it would be a hassle if I had to go to the boat rental place, rent the boat, put it in the thingy, do the thingy, and return it every time when it's like, yeah, but I use it 4 times a week. Well, at some point, ownership does make sense, but not a lot of people get that. The pool quote is the one where I'm like, oh, I know personally, like pools can quadruple in price.
Yeah.
And it's one of those where it's like, maybe it feels good at 60,000. Would it feel good at 160,000?
Be a tough pill to swallow at that point.
Here's another one. You like pickleball.
Yeah.
And I saw a $25,000 budget for pickleball court. And dude, I get it. I put a racquetball court in my house, right? But here's my question. How often do you play pickleball?
So my wife is really into pickleball these days. We would play way more often if access were a lot easier.
Yeah. Have you looked at the nearest places that you can go to do pickleball?
We play on them.
And how far away are they?
They're not far. Pickleball is really popular in Utah right now. And it can be really annoying. You go to some of these places, and if you don't time it right, you're sitting on the sidelines waiting for someone else's game to win. You hop in, play one game, and then someone's like, I got next. And there's a lot of waiting.
How far away are you from Stephen Miller's house where he owns a private one?
So, yeah, that's
15 minutes?
Yes. Yes. 20 minutes from Stephen Miller's. Yeah.
Do you understand
Stephen
a
Miller's
little bit?
amazing, but it's awkward. If he's not going to be there, it's awkward to go play on it.
Oh,
right?
so awkward is worth 25 grand.
If I had 25 grand lying around, then yeah.
No, you wouldn't. Because you'd take 25 grand, Mr. and Mrs. Conservative, and you'd do what?
Yes.
And this is what I was warning you about in that video. It's like, okay, when I hear 1.3 million, here's what you don't account for. First, it's a pool. And then it's a pickleball court. And then it's a theater room.
Yep.
And then it's just one extra finished bedroom in the basement. And, oh, family might come by you. Let's also finish the bathroom because it'd be more convenient. And then, well, I do think that this, granted, it would be nicer than the solid surface countertop. On a house that's 1.3 million, there's hundreds of thousands of dollars of discretionary.
Right.
And so you get in this pattern of like, well, it's just one more thing. One more thing. If you can say yes to one more, you can say yes to 10 more.
Yep.
And if you can say yes to 10, your portfolio is going to stop growing.
And I totally get it. And the other thing that's been cool is we've been finding interesting solutions. For the pickleball thing, we're already having a driveway put in, and we went out and did some measuring, and I think we can fit the pickleball just on our driveway. We just have to paint lines.
Yeah, so what's interesting about that is like, that was one of my next thoughts is like, dude, your driveway, is it flat?
Yes.
And do you have a portable net? And then all of a sudden it's like, pickleball.
Oh, we can do it. Yep.
Right?
Yep. And achieve the same thing.
Yeah, it's interesting. We live in a world, especially here in America, where it's so easy to want the newest and nicest thing. I'm speaking as a man that just finished a $28,000 square foot addition on my home. And I'm looking at my choices over the last couple of decades as I'm mentoring you. And there's a sequence. There's a time and a place for stuff. And if you're premature, your financial future will suffer. And if you're late, then your experiential life will suffer. And so it's really about, how do I find the balance? And these jerry-rigged notions of like, yeah, we're actually just going to play on the driveway. We found a way to make that work. It's not as cool as when you have a dedicated. For sure. But
But we really do want the pickleball for playing. To me, that's telling. The moment my wife was like, I think we could just do this on the driveway, I'm like, you actually just care about playing pickleball, not the status of having a pickleball court. She's like, she just really wants more practice time for it. And that I get.
Here's the cool part. You, I think, came up with a way to save around $220,000. And when I started running your numbers, I don't have the final numbers yet, but I'm like, wait, that might turn the tide, because there's a difference, as you now know, between equity and usable equity. And if your house ends up appraising at, what's your guess?
1.4.
If you're coming in at $1.4 million on the house, and if what you end up owing now with $220,000 less spend is $1,090,000, let's just call that 1.1. If I'm into it 1.1, and you got to be really careful as you do your finishes to make sure you land there. If a bank would allow you to go up to 90% of 1.4, I can pull up my calculator right now and just tell you roughly where this is going to make a difference for you. Let's do the math here and actually let's vet this right here. You're going to be into your house about 1.1 million, but you have the $320,000 credit.
Yep.
So I'm going to subtract the 320, and that tells me that you're going to owe right now about 780. So I'm going to take 1.4 million, and I'm going to subtract 780,000.
Which, by the way, I just want to throw this out while you're doing it. Right now, jumbo loans, their cusp is right there at the 780.
Yeah.
We're doing everything we can to hit just below that, so
Smart.
we don't have to do that jumbo loan.
Yeah, so you want to be able to come into those lower rates too.
Yes.
That's going to give you an equity of 620,000. Now, if the bank allows you to go up to 90%, let's just say, let's subtract the 140,000 from that. That would give you a HELOC of $480,000. If they only allow you, this is big, it's almost $500,000.
Jeez.
If they only allow you to go up to 80%, try some different community, credit unions and banks and whatnot. I'll subtract another 10%. You'd still have $340,000. So
you're saying we can get it back out?
if you went back in started the project with 320, and I'm just smacking my forehead saying, stop, I need that for real estate. It looks right now theoretically like you can get your 320 out. And dude, if you can have the house, rent the loft, have it cover more than half of the mortgage, and then still have every penny out that you put in, you're not going to regret that. You're going to feel good. And I look at the 3 homes that you lived in then. You started with a small home. It appraised in value, but you had someone else paying for over half of the mortgage. Went into the second house. You only increased your mortgage $100 because you did the same strategy. Now your mortgage is going to be very similar again. I mean, your portion might be $1,700 or something. But for the amount of money you make, it's a really smart move.
Yep.
That's what I needed to see, dude. If I'm going to, if you're going to be my apprentice and I'm going to really mentor you and continue in the game, you've got now $300,000 to $450,000 there. You have $150,000, $160,000 in your 2 Florida properties that I would leave and let mature a little bit more first. And then, you got $300,000 in the primary residence that you are planning on selling, right?
We're in talks with Tyler on that. There's some debate on whether it would benefit to hold the asset, because we could count, I think it's like 75% of the rental income against our debt to income.
Yeah, I'm not
leaning
concerned.
towards selling.
I'm not concerned with your debt to income ratio. What has me really concerned for you is having a rental that's worth over $400,000. This one's almost $630,000 or $650,000.
Yep.
That's it.
And PG is super Nazi about owner occupied or single family. They will not let us do the duplex thing.
Yeah.
And they we have neighbors that have got called out on it.
There's a workaround. There's a workaround. If you do a lease option and put them on title, and then you can take them off title if they misstep or they don't make a payment. Utah's a race state, which means that you can take them in and out. I did that on one of my properties, and it actually worked out well. So you have options, but I wouldn't want to, the moment I have a property that's more than half paid off, I get really antsy. I'm like, I need that equity. And I would rather sell the house. Would rather take that and multiply that into a few more.
That's the direction I'm leaning to.
Yeah.
One other cool thing about the new build is that we've allocated a space in it for my wife's massage therapy business.
You got to bring some business.
And bringing in some money.
And
there's
a side door, side entrance or whatnot. And
And there's a little bit of tax benefit there. We can say we're using part of our home, but the real gain is that my wife loves that. And then we already have a ton of people that have said, where are you like doing stuff? And she's like, I don't have a super great space yet.
Yeah.
And so it would allow her to be bringing in that revenue as well.
So you actually have a couple more tax write-offs that I'll just hit real quick.
Okay.
So you can write off up to a certain percentage of your house for home office. And it doesn't even have to be the designated space. You're now a real estate investor. You have a business. Your wife has a business. So you can go for a maximum write-off allowable for that.
Okay.
It's not just the square footage of the space itself. I would look into that, right? Talk to your
That's
CPA. Awesome. The second thing is there's something called the Augusta rule that allows you to rent your house for up to 14 days a year. And you get to choose whatever market rate feels good. So you could do a corporate retreat at your house or use it for filming or use it for some other outside purpose and say, well, my company charged me $1,500 a day because we got the whole house and we used these different amenities and whatever. And you do that for 14 days of the year. And it's like, oh, that rental rate times that many days, it's something, right? It's something that will definitely save you thousands of dollars in taxes. So you have a couple of things to look at there.
That's really, really cool.
Yeah. Big thing, man, is you salvage the deal. Because I seriously was like, why would I actually apprentice you if you're kind of done? And I don't want to sell your 2 Florida homes yet. I don't think they're fully matured.
Yeah.
Right?
Yeah,
I don't quite have enough to pull out and buy. I can replace them, but I want to do more than that.
Right. And Tyler feels very similar to you on that. So we'll probably just continue to hold.
You got them in 2020. You've locked in probably 3 or 4% interest rates. They're so low right now. The money is so cheap. So even refinancing and pulling the money out at a higher rate just to invest it and keeping the asset, I don't think it's there yet. It's close.
Yep.
The good news is the game is on, man. The game is afoot and we get to play.
The real question, I'm feeling good here. You're saying I salvaged it. You moved forward and said, I'll take you on as an apprentice, which feels really good. And I'm just like, what are you going to make me do next?
Well, to be honest, dude, I am going to ask you to do a lot of super uncomfortable things, but those are the things that you do for building wealth.
Right.
Like, just look at any entrepreneur that carries all the burden. And if you ask them, what's the hardest thing you do? The truth is most people wouldn't do it, so they can't get what they got. I think real estate's very similar. I've pioneered a couple conversations coming up that I'm not ready to release. I don't think you're going to be a fan of, but I can promise you this. I wouldn't ask unless it was going to be for your family's good and make you more money.
For sure.
And so the worst thing that can happen is you fail.
Yep.
But if you never try, what does Wayne Gretzky say? You miss 100% of the shots you don't take.
Wait, was that Wayne Gretzky or was that what's head from The Office that said that?
No, definitely not Michael Scott.
Michael Scott quoting Wayne Gretzky.
Yeah.
Yep.
So you're in a good spot, man.
Okay.
And I'm proud of you. Like, you started your real estate journey how many years ago?
Actually getting in it, 2016.
2016. Right now, you have over $1 million of net worth.
Yeah.
You're a millionaire. So you've been in it for 8 years. You're a millionaire. You have several doors, and you started as a poor college kid with nothing.
And I want to express a ton of gratitude to you and to God and all the cool things that have happened. But I also have to temper it and say, the past few years, inflation has definitely made it feel like being a millionaire ain't what it used to be.
Yeah, but you're also, that same inflation is actually what's making you your money. Without that inflation, your net worth would be dropped down in the last 5 years by several $100,000. And so, yes, inflation does make the money you spend feel less, but the more homes you own, like when you get ready to go buy 5 or 6 or 7 more, I can tell you we're still in the middle of this historic real estate shortage of 4.5 missing single-family homes.
Yeah.
And what that's going to do is now we have Trump coming into office. Trump is bringing taxes, tariffs, and mass deportation. The people building our homes, they're not illegal. The building material prices are going to go up. We are going to see inflation, which is bad for the consumer index, and it is really good for the investor index.
Right.
This next year is probably going to be great. I would encourage you as quickly as possible to get your next homes, because it's like when we have more of those good years like I'm talking about, I'm forecasting. I think I read a report that said by 2029, over the next 5 years, they're expecting a 17% increase in real estate. And I'm like, no, it's way bigger than that. But take it at its face value and take 17%. And if you go and buy another $1 million worth of real estate, that's another $170,000 that you get for existing, for receiving positive cash flow and for having tax benefits. That's what's going to take you from a millionaire to a multimillionaire.
Dude, let's go. Game on. I'm here for the ride. And I say I'm nervous about some of the assignments you're getting ready for me, but I'm also committed. I'm in it. I'm willing to do it.
Let's go.